Welcome to the Deep Dive. Today we're digging into the Q3 2025 earnings from Moody's Corporation. That's ticker MCO.
Yeah, and looking through the materials, the transcripts, the presentations, the new guidance, there's one clear message coming through.
Which is?
Earnings power on full display. That phrase really captures it. It was an exceptionally strong quarter.
Right. So our goal here isn't just to read you the numbers. We want to help you understand how they pulled this off.
Exactly. We're going to unpack the performance of their two main businesses, Moody's Investor Service, or MIS, and Moody's Analytics, MA.
And crucially, we need to look at the economic assumptions they're making. Because they didn't just report good results, they significantly raised their forecast for the whole year.
Which tells you something about their confidence.
Absolutely. So let's start with those big headline numbers.
Sure.
Quarterly revenue, over $2 billion for the first time ever.
That's up 11% compared to last year. Solid growth.
But the real kicker was the bottom line. Adjusted diluted EPS. That's earnings per share adjusted for certain items. It hit $3.92.
Wow, okay. That's a huge jump, 22% year over year.
22%. That kind of number, it screams more than just sales growth, right? It suggests they're getting really efficient.
Yeah, that points straight to operating leverage. They're getting more profit out of each dollar of revenue.
Let's unpack that leverage story because it really defined the quarter. Across the whole company, the adjusted operating margin expanded. Get this, 510 basis points year over year.
Okay, hold on. 510 basis points, that's 5.1 percentage points. So their margin landed at 52.9% for the quarter.
52.9%, that's impressive.
It really is. It means a much bigger chunk of that new revenue is dropping straight to profit. You know, the CFO even called it a powerful earnings engine.
Delivering double-digit EPS growth and generating significant free cash flow. That was the quote. But here's a question, though. When you see margins jump like that, 5.1 percentage points, how much of that is sustainable efficiency versus just, well, a flood of high-margin business this specific quarter?
That's the key question, isn't it? A lot of this is driven by the very hot MIS segment, which we'll get into, very high-margin stuff.
Right.
But Moody's would argue there are also underlying operational gains, especially within the MA side. The real test is if they can hold on to some of that margin gain when or if the market cycle turns.
For now, though, the volume seems to be overwhelming everything else.
It does. And that performance, that confidence, it led directly to them boosting their full-year guidance, which is what the market really watches.
They really moved the goalposts here. Total revenue growth for the year, they bumped that up from mid-single digits to high single digits now.
Okay, so better than expected top line.
And the big one. Adjusted diluted EPS for the full year, they raised the range to $14.50 to $14.75.
$14.50 to $14.75. So the midpoint there implies, what, about 17% growth over last year?
17% growth year over year. That's a very strong signal.
And that kind of performance, it obviously gives them a lot of financial firepower.
Yeah, exactly. Free cash flow guidance raised to about $2.5 billion for the year.
$2.5 billion.
And they're putting that cash to work for shareholders. They upped their share buyback commitment to at least $1.5 billion, up from $1.3 billion.
Right. So generating cash, returning cash, it's the classic playbook when things are going well. Investing in the future, but also rewarding shareholders now.
Okay, so let's pivot to the engines driving all this. We have the two sides, Moody's Investor Service, MIS, and Moody's Analytics, MA. Let's start with MIS.
MIS is the ratings agency side, the more cyclical part of the business.
And they had a monster quarter. Record revenue, $1.1 billion, up 12%.
And remember that margin discussion. MIS adjusted operating margin hit 65.2%.
Yeah, that tells you when the debt markets are active, MIS prints money. It's their high-octane engine.
So where did all that rating activity come from in Q3? What was getting rated?
It was overwhelmingly driven by refinancing, particularly in leveraged finance.
Leveraged finance, so companies with higher debt loads. Exactly. We saw leveraged loan issuance volume jump 58% in the quarter. High-yield bond issuance volume was up 57%.
58 and 57%, just massive increases. So companies were rushing to refinance existing debt.
That seems to be the story. A lot of debt taken out years ago at lower rates is maturing, and companies needed to lock in new financing, even at today's higher rates, before those maturities hit. They need new ratings for that.
Makes sense. It wasn't just corporate debt, though, right?
No, financial institutions also had a huge quarter, their strongest in over a decade for what they call infrequent issuers in banking. Revenue up 22% there.
Okay. And structured finance.
That was mainly driven by CLOs, collateralized loan obligations.
Ah, so packaging up those leverage loans we just talked about.
Precisely. When leverage loan issuance is booming, like it was, the CLO market, which securitizes those loans, naturally follows. It shows the whole chain is working and liquidity is there.
This all feeds into the big structural story for MIS, doesn't it?
Mm-hmm.
This idea of the refinancing wall.
This is probably the single most important forward-looking factor for them. It's massive.
We're talking about years of low rates encouraging companies to take on debt. And now it's all coming due.
The numbers are staggering. For U.S. and EMEA non-financial corporates, the amount of debt maturing that needs refinancing or repayment is over $5 trillion.
The specific number they highlighted in the materials, $5.2 trillion in refinancing needs just between 2025 and 2029.
5.2 trillion. And here's the really crucial insight for you listening. Moody's analysis shows that figure has basically doubled since 2018.
Doubled. So this isn't just a normal cycle, it's structurally bigger.
It seems so. Low rates pulled a lot of borrowing forward, extended durations, and now that wave is hitting the shore in a higher rate environment. That creates a huge, almost guaranteed pipeline of demand for ratings over the next 5 years.
It's a built-in demand engine.
Absolutely. And they're not just relying on that. They also pointed to growth areas like private credit, sustainable finance,
Transition finance.
emerging markets debt, and even things like data center infrastructure and digital finance. They project like a 10% compound annual growth rate for those combined.
So diversifying while the main engine runs hot. Makes sense.
Okay, so that's MIS. High flying, cyclical, riding this huge refinancing wave.
Now let's talk about the other side, the counterbalance. Moody's Analytics or MA?
MA is the steadier piece. Data, software, risk solutions. Much more predictable because it's largely subscription-based.
Right, so MA revenue was $909 million. That's up 9% as reported.
And about 6% if you strip out currency effects and look at organic growth. Still solid.
And their margins expanded too. They're not as dramatically as MIS. Adjusted operating margin for MA was up 400 basis points.
So 4 percentage points landing at 34.3%. Healthy expansion there too.
And the key number for MA is the recurring revenue percentage. How much of that $909 million is stable, predictable subscription money?
It's incredibly high, 96%.
96%. That's amazing stickiness. Customers sign up and they stay. These tools get embedded in their workflows.
And that's clearly the strategy. They actually mentioned that transaction revenue, one-off sales, was down 19%.
Deliberately shifting away from that.
Exactly. They're prioritizing the stable, long-term subscription relationships over volatile one-time deals. Smart move for stability.
That focus really shows up in their ARR metric, annualized recurring revenue.
ARR gives you a snapshot of the annual value of their current subscription contracts. It hit $3.4 billion.
$3.4 billion, growing 8% year over year. Steady growth.
And within MA, the fastest growing bit was in decision solutions, specifically KYC, Know Your Customer Solutions.
KYC. Why is that growing so fast?
Think about digital onboarding, supply chain checks, anti-money laundering, sanctions screening. Regulatory pressure and the need for efficiency are huge drivers. KYC ARR grew 16%.
16%. Okay, so that's clearly a hotspot.
Definitely. And MA isn't just selling static data. They talked about leveraging deep currents like digital transformation, risk awareness.
And generative AI. They mentioned Gen AI for productivity games.
Right. They're positioning themselves as technology partners, helping clients navigate complexity with smarter tools. That's how they justify the subscriptions and keep that 96% recurring revenue.
Okay, so we've seen the two engines. The cyclical power of MIS, driven by debt, and the steady recurring growth of MA, driven by data and risk solutions.
A pretty compelling combination right now.
But this all rests on certain assumptions about the future. The raised guidance is only good if the economic picture unfolds the way they expect. Let's talk about those macro assumptions.
Yeah, this is crucial. What are they betting on? They laid out tailwinds and headwinds.
Tailwinds are the good stuff. Tight credit spreads, making debt cheaper to issue, strong investor appetite for that debt, M&A picking up.
And of course, that massive wall of maturities we discussed. That's the biggest tailwind.
Okay, but the headwinds are pretty significant too. Geopolitical risks, they specifically mentioned Russia, Ukraine, and the Middle East conflicts.
Plus, uncertainty around U.S. trade policy and the fact that funding costs, while maybe easing slightly, are still elevated compared to a few years ago.
It's interesting they list Improving M&A as a tailwind, but geopolitical uncertainty as a headwind. Don't those kind of work against each other? M&A usually likes stability.
That's a great point. They seem to be betting that the fundamental need for companies to refinance and grow will outweigh the drag from global tensions, at least for now. It's a calculated risk.
And they put numbers on these assumptions. Updated forecasts as of October 22nd. Global real GDP growth. They actually raised their forecast slightly, now expecting 2.0% to 3.0%.
Okay, so cautious optimism on global growth.
Same for the U.S. They raised the U.S. real GDP forecast to 1.5% to 2.5%. Still positive growth expected.
But here's the absolute linchpin, the critical assumption underpinning everything, especially the MIS outlook.
Monetary policy, what the Fed does.
Exactly. Moody's guidance explicitly assumes the Federal Reserve will cut the federal funds rate twice in the fourth quarter of 2025.
2 rate cuts expected before year-end. That's a very specific call.
It is. The expectation of lower borrowing costs is what keeps that refinancing engine humming. If those cuts don't happen,
If the Fed stays on hold, or worse, hikes, then the cost of dealing with that $5.2 trillion debt wall suddenly looks very different.
very different. It could significantly slow down issuance activity, hitting MIS revenues hard. Their guidance depends heavily on those cuts.
It's an explicit dependency baked right into the numbers.
On the flip side, they seem fairly optimistic about credit quality. They expect the global high-yield default rate to actually decline to around 3.7% by the end of 2025.
3.7%. That's below the long-term average, isn't it?
Yeah, the historical average is about 4.2%. So they're basically saying they expect most companies, even high-yield ones, to manage through this period without a huge wave of defaults.
Okay, so let's try and wrap this up. What's the takeaway from this deep dive into Moody's Q3?
Well, you've got a company firing on really both cylinders right now. You have MIS, the cyclical ratings engine, benefiting massively from this huge wave of corporate debt needing refinancing, huge leverage there.
And then you have MA, the stable, recurring revenue side, providing ballast with its focus on essential risk and compliance solutions, like KYC, insulated somewhat from market swings.
And the combination led to that significant raise in their full-year earnings guidance. They're clearly confident.
But, and it's a big but, that confidence, especially regarding that $5.2 trillion refinancing pipeline, rests heavily on a fairly smooth economic path ahead.
And specifically, it hinges on getting those 2 Fed rate cuts in Q4. That's the key thing for you, the listener, to watch.
If monetary policy deviates from that script, if rates stay higher for longer, or if we see a sudden spike in interest rate volatility, how does that change the maths for companies facing that debt wall?
That's the critical question.
Which brings us to our final provocative thought. Moody's outlook assumes relative stability, a glide path to easing. But what if those geopolitical headwinds flare up? What if bond market volatility surges? Could that $5.2 trillion opportunity suddenly morph into a dangerous bottleneck?
Right. Could companies be forced towards default instead of refinancing at punitive rates? And how quickly could that shift Moody's own revenue picture? That's the big uncertainty hanging over what was, on the surface, an absolutely stellar earnings report.
Something to definitely keep an eye on.